Gold is moving again. Silver is moving too, but this time, they are not telling the same story. Gold is climbing because fear is back in the system. Silver is flashing something even more dangerous. It is hinting that the problem is no longer just inflation, no longer just rates, no longer just geopolitics. Silver is signaling a deeper crack inside the global economy, and most people still do not see it. What happened is simple on the surface. Gold started attracting capital again. Investors who were happy to chase stocks, ignore debt, and trust central banks are suddenly rotating back into safety. That alone would be important. But silver is not behaving like a normal sidekick in this move. It is sending a more complicated message. And when gold and silver split like this, it usually means the market is no longer debating growth. It is starting to question the structure holding growth together. That is the real story here. Because when gold rises, the easy explanation is fear. Fear of inflation, fear of recession, fear of war, fear of policy mistakes. Gold does very well when investors stop trusting promises and start trusting scarcity. But silver is different. Silver sits in two worlds at the same time. It is part monetary metal, part industrial metal. It trades like insurance and like a growth asset. So when silver starts signaling stress, you are not just looking at fear. You are looking at pressure building in the real economy. And that is where this gets more serious than most headlines admit. Gold can surge because investors want protection. Silver can warn that the engine underneath the market is starting to misfire. That split matters because it tells you whether the panic is emotional or structural. And right now, the signal looks structural. Think about what gold really represents. It is the asset people run to when they stop believing that policymakers are in control. It does not need booming earnings. It does not need strong GDP. It does not need a hype cycle. Gold only needs doubt. Doubt about fiat currencies. Doubt about deficits. Doubt about the stability of financial plumbing. The moment that doubt grows, gold starts pulling capital from the sidelines. And there is no shortage of doubt right now. Governments are carrying debt loads that no longer look temporary. Central banks are trapped between inflation risk and growth risk. Bond markets are no longer giving clean signals. Consumers are stretched. Credit stress does not disappear just because stock indexes look resilient. Under the surface, pressure is accumulating in slow motion. Gold sees that before the average investor does. Gold does not wait for the official narrative to catch up. But silver is the more uncomfortable part of the conversation, because silver asks a different question. Gold asks, do you trust the system? Silver asks, can the system still function smoothly from here? That is a very different level of concern. Gold can rise in a world of fear. Silver starts screaming when fear collides with industrial fragility, liquidity strain, and policy confusion. That is why silver's message is so much more dangerous when the economy is already stretched. Most people still think of silver as cheaper gold. That is the mistake. Silver is not just a smaller gold trade. It is a pressure gauge. It reacts to manufacturing demand, energy demand, electronics demand, capital rotation, monetary stress, and investor psychology all at once. It is one of the few assets that can tell you whether the monetary story and the industrial story are starting to clash. And when those two stories collide, you do not get a normal slowdown. You get cracks. That is the bigger economic crack hiding in plain sight. Because on paper, the market still wants to believe in a soft landing story. Maybe growth slows, maybe inflation cools, maybe rate cuts arrive at just the right time. Maybe asset prices stay elevated. Maybe consumers keep spending. Maybe credit stays orderly. Maybe nothing breaks. That is the dream. That is the version of reality markets keep trying to price. But precious metals do not seem convinced. Gold is saying confidence is fading. Silver is saying the real economy may not absorb the next shock cleanly. That distinction changes everything. It means this is not just about bullish metal charts. It is about a warning from assets that historically move first when trust starts breaking down. And this is where people get trapped. They look at a rising gold price and assume it is simply another inflation hedge trade. That explanation sounds comfortable because it keeps the story small. But if gold were only rising because inflation might stay sticky, the signal would be easier to dismiss. What makes this move different is the backdrop. Growth is not clean. Debt is not sustainable. Policy credibility is not strong. Liquidity is not infinite. And the industrial side of silver is starting to interact with those weaknesses in a way that feels far more unstable. In other words, this is not just a metals story. It is a confidence story. confidence in governments to manage debt, confidence in central banks to manage rates, confidence in markets to price risk honestly, confidence in companies to maintain margins in a slower world, confidence in consumers to keep spending while financing costs stay painful, confidence in the entire economic bridge between growth and stability. And the bridge does not look as solid as investors want it to. That is why gold surging again matters. It means money is quietly preparing for disorder. But silver signaling a bigger crack matters even more. Because silver is tied to how the real machine operates. If it starts telling you something is off, you should pay attention. Now here is what most people are missing. The real danger is not one dramatic collapse tomorrow morning. Markets rarely give you that on schedule. The real danger is a slow fracture, a sequence. Growth softens, debt servicing costs rise, consumer resilience fades, credit conditions tighten, industrial demand becomes uneven, policymakers respond too late or respond in the wrong direction. Then capital starts moving defensively before the official data fully confirms the damage. That is exactly the kind of environment where gold starts rising ahead of consensus, while silver begins revealing the crack underneath the consensus. And once that process starts, it becomes self-reinforcing. Because a defensive move into gold is not just a trade, it changes behavior. It signals that investors would rather protect than expand. It signals that capital is becoming more selective. That hurts the broader economy because risk-taking is one of the fuels of modern growth. When big money starts choosing protection over participation, the economy loses momentum even before recession headlines arrive. Silver makes that tension visible. If silver lags at the wrong time, it can mean industrial confidence is weakening. If silver erupts later, it can mean investors have realized the crack is worse than expected and are rushing into hard assets all at once. Either way, silver is rarely quiet in periods like this for long. It becomes a messenger, and the message is usually uncomfortable. The uncomfortable part is that policymakers may already be boxed in. If they stay tight for too long, the economy slows harder and financial stress deepens. If they ease too early, they risk reigniting inflation and weakening currency credibility. If they try to split the difference, markets may interpret that as confusion. Gold thrives in every one of those scenarios. Silver reacts depending on whether the next shock comes from deflationary stress, inflationary panic, or industrial dislocation. That is why silver's signal can look messy at first. But messy does not mean irrelevant. Messy often means the market is wrestling with multiple risks at the same time. That is exactly what a crack looks like before it becomes obvious. The bigger implication is this. The system may not be transitioning from crisis to stability. It may be transitioning from one form of instability to another. That is a huge difference. Investors keep waiting for the clean handoff, where inflation comes down, rate cuts arrive, growth survives, consumers remain okay, and markets normalize. But what if normalization never really comes? What if the next phase is just different stress wearing different clothes? Gold is already preparing for that possibility. Silver is starting to hint that the next phase could be more disruptive than consensus expects. And that is where the opportunity and the risk collide. Because once markets realize the crack is not temporary, metals can reprice fast. Not in a smooth, straight line, but in violent bursts. First, the smart money moves. Then the skeptical money moves. Then the late money moves. By the time the average investor finally accepts why gold is rising, the easy part of the move is often gone. By the time they understand what silver was signaling, the broader market has already started reacting. This is why these moves matter before they look obvious. Look at the psychology. In complacent periods, investors trust paper claims. They trust earnings projections. They trust government messaging. They trust that any slowdown will be managed. In uncertain periods, they start preferring what cannot be printed, cannot be promised into existence, and cannot be patched by a press conference. Gold benefits first because it is the cleanest expression of distrust. Silver enters when the market starts confronting a more complex truth. If the economy weakens while inflation risks remain sticky, the policy toolkit becomes much weaker than people assume. That is when silver stops being a side asset and becomes part of the core macro story. And that macro story is not comfortable. Because the world has spent years stacking one imbalance on top of another. Cheap money created excess leverage. Excess leverage created asset bubbles. Asset bubbles created political incentives to protect prices. Protecting prices required more intervention. More intervention distorted the signal from rates and bonds. Distorted signals encouraged more bad capital allocation. Then inflation returned. And once inflation returned, the old rescue playbook became harder to use without consequences. That is the crack. It is not one single event. It is a chain of dependencies that now looks fragile from multiple angles at once. Gold is responding to the fragility in trust. Silver is responding to the fragility in function. That difference matters because trust can fall long before function breaks. Gold can move first. Silver can confirm later. And when silver confirms, the market usually realizes the issue is not just fear. It is damage. So where does this go from here? There are really only a few paths. If growth stabilizes cleanly, silver could eventually benefit from industrial recovery and join gold in a broader metals surge. That would be the optimistic version. But even that would imply strong demand for real assets in a world where paper confidence remains shaky. So metals still matter. If growth weakens harder while policymakers stay cautious, gold likely remains the preferred safe haven, while silver becomes more volatile as industrial expectations wobble. That would be a warning that recession stress is arriving faster than hoped. And if policymakers pivot aggressively in response to economic weakness, then the game changes again. Gold could surge on currency distrust and real rate compression. Silver could eventually explode higher too, as monetary demand combines with any recovery in industrial expectations. That is the scenario people underestimate because they assume silver needs a perfect economy. It does not. It needs a recognition event. It needs the market to understand that the old balance is gone. That recognition event may be closer than investors think, because the broader market still feels far too relaxed about the possibility of simultaneous stress. Slower growth, higher debt costs, political pressure, fragile consumers, unstable credit, sticky inflation risk, disrupted industrial demand. Those forces do not cancel each other out. They compound. And compounding stress is exactly what precious metals were built to detect. Gold is not rising for entertainment. It is rising because capital senses instability. Silver is not flashing for no reason. It is flashing because the instability may be spreading from the monetary layer into the economic layer. That is the bigger crack. And here is the part that becomes dangerous for the broader market. If investors eventually realize that gold was right and silver was early, the rotation into defensive assets could accelerate in a way that drains oxygen from everything else. Growth stocks would no longer be priced for ideal conditions. Bonds would no longer be trusted as a clean hedge if inflation remains sticky. Cyclical trades would struggle if industrial momentum fades. Suddenly, the list of places to hide gets very short. That is when metals stop looking like a niche trade and start looking like a macro necessity. You do not need a doomsday collapse for that to happen. You only need enough disappointment to break the illusion of control. A weak jobs trend here, a credit event there, a policy mistake, a renewed inflation scare, a geopolitical shock layered on top of a debt-heavy system. Markets can absorb one problem. They struggle when several problems start feeding each other. Gold knows that. Silver is starting to price that risk too. And once the market understands that this is not just a temporary wobble, the conversation changes from "why are metals moving?" to "why didn't we listen sooner?" That shift is where the biggest repricing happens. Not when the first buyers step in, when the doubters finally surrender. That is why this moment matters so much. Because if gold is surging again, while silver signals a bigger economic crack, then the real message is not about metal alone. It is about confidence leaving the system in stages. First, quiet doubt, then visible hedging, then broader recognition, then capital rotation, then a new pricing regime. We may be much earlier in that sequence than the headlines suggest. And if that is true, the most important thing is not chasing every daily move. It is understanding the signal before the crowd fully accepts it. Gold is telling you fear is back. Silver is telling you the fear may be justified by something deeper than a headline cycle. Together, they are pointing to a system that looks less stable than it appears on television. That does not guarantee one straight-line outcome. Markets never work that cleanly. Volatility will stay brutal. Narratives will flip. Some days metals will look unstoppable. Other days they will look broken. But the underlying message matters more than the noise. Gold is demanding safety. Silver is questioning stability. That is not a random combination. That is a warning. And warnings matter most before the damage is obvious. So the real takeaway is this. Gold surging again is not the whole story. It is only the visible part. The deeper story is that silver may be exposing a fracture running underneath the economy, a fracture tied to debt, policy, industrial weakness, and fading confidence all at once. That is why this move deserves attention, not because gold is strong, because the combination of gold strength and silver's signal suggests the next chapter could be far more disruptive than investors expect. The market still wants reassurance. Precious metals are not giving it. They are giving you something else, a preview. And previews like this do not show up when everything is fine. If you have been watching gold and silver as just another chart, you are missing the point. These metals are speaking the language of trust, stress, and transition. Gold is saying the old confidence is fading. Silver is saying the economic machine may be closer to a crack than the official narrative admits. That is the real signal. And if that signal is right, the biggest move is not the one already on the chart. It is the one that starts when everyone else finally understands why it happened.